Okay. Good morning, everyone. Thank you for joining us and welcome to our webinar today, focusing on the future of the real estate sector and the ever-changing landscape for REITs. My name is Richard Levy. I'm a real estate audit partner in BDO with a particular focus on the REIT market. Before I introduce our panel, I wanted to comment generally on what we as BDO are currently seeing in the market. Despite AIM in the main market falling by over 30% in March 2020 due to the effects of the pandemic, 2020 and 2021 were huge years for fundraisers. 2021 was the fastest growing year for the FTSE since 2016, and AIM saw the highest level of fundraise since 2007. Across both AIM and the main market, there were huge surges in IPOs across all sectors, with 87 new admissions in 2021 and over $3.5 billion raised by real estate and REITs. We continue to see significant interest in REIT and real estate linked IPOs, including a real focus on ESG, with issuers and investors taking a keen interest in environmental and societal impacts as part of their strategies. Home REIT and Atrato On-Site Energy are just two of the successful examples from the last 2 years, but there are many more, hopefully, in the pipeline. It's almost exactly 2 years from the initial C-19 lockdown, and while we continue to emerge from the impacts of the pandemic, clearly the markets are currently grappling with wider economic and geopolitical challenges with some very strong headwinds. However, the good news is that there appears to be a queue of new real estate businesses looking to list once the markets level out. And of course, there's also the imminent changes to the REIT regime from the 1st of April, which will allow unlisted UK REITs. BDO are fortunate to act for over half of all UK listed REITs, and we audit 19 groups. In the wider market, we are the #1 reporting accountant for IPOs on AIM and the main market over the last 5 years, and the #1 auditor to UK listed companies. This position gives us a unique insight into the impending changes to and challenges faced by the UK real estate and REIT industry. So, on to our panel. We are delighted to be joined this morning by the following. Tom Yeadon from Jefferies Group. Tom has over 15 years of corporate finance and brokering experience, and he is here today to give us an insight into the current REIT market and the major trends which are affecting the sector. Matt Brookland. Matt focuses on the ESG agenda at BDO with a specific emphasis on environment and sustainability. He's going to talk us through how ESG is really changing the business landscape. Vince Wood. Vince is a BDO tax partner with many years experience advising clients ranging from large fully listed and AIM groups to smaller startups. He is here today to talk us through the upcoming legislation and tax changes which will impact REITs and the UK property market. And Simon Hall. Simon is a director in our M&A team who specialises in real estate M&A. He has advised a broad range of real estate clients, including numerous REITs, FTSE 100 to 50, AIM and other listed companies. Simon is going to facilitate our Q&A discussion towards the end of the session. And that leads me to remind you to please use the Q&A function to submit your questions to our speakers throughout the session, and we'll try to get through as many of these questions as we can later. A copy of this morning's slides, as well as a recording of the session, will be circulated shortly after the event. And with that, I will hand over to Tom to kick us off. Tom, over to you.
Thank you, Richard, and good morning, everybody. So probably just turning to the first slide, I'm just going to spend 5-10 minutes introducing the REIT sector, some of the key themes that we're currently seeing. And Lara, if we go to the first slide, so just sort of the basic overviews. There are over 80 listed property companies on the UK London Stock Exchange. These are REITs and offshore funds, and they are concentrating on shops, sheds, offices, all the alternative subsectors, as well as several who are a bit of everything. What we see is various structures. There are internal versus external management structures. There are companies that focus on sort of buy and hold investment sort of tactics, whilst there are others that are more development focused. So it is a broad and diverse pool of companies that we're seeing here. What I'm showing with this graph, though, is something slightly different. Of course, by being a listed security, although property itself, direct property, is relatively uncorrelated to the wider equity markets, by becoming a listed security, you actually become more correlated. And therefore, whilst we will talk about sort of direct property and some of the themes that are affecting that, it's important to bear in mind that when you become a REIT, you are also going to be affected by the wider equity markets and the themes and issues that those equity markets are experiencing. Probably just turning on to the next page. So, very sort of brief overview, and I'm conscious that many of you will already know this. Income is obviously a key part of the return for all REITs and property companies. However, the key valuation metric that we still use is NAV per share. Given that equity markets are forward-looking, that comparison of NAV per share versus share price allows us to see companies that are trading at a premium and discount, and that allows us to read trends, and it allows us to see what subsectors of real estate are in the vogue, and what subsectors are investors really struggling with at the moment. No real surprises here when we look at this chart. The retail on the left, all trading at big discounts, and that's a combination of the storm that some of those companies have found themselves in, and some of those wider macro trends, including the growth of the internet, etc. Equally, on the flip side of that coin, we see industrial and logistics all trading at premiums. And bear in mind, when we look at NAV per share, it's a historic measure, and therefore, as these numbers move around, we've seen some huge NAV increases from companies such as Segro over the last couple of months. I think the other thing I kind of mentioned when I talk about this slide is the alternative stocks, and this hasn't really changed for the last 5 years. They have been very highly rated, better rated than the traditional sectors, and those alternatives include people like the student property sector, the storage sector, healthcare, and long income. And again, it's playing into themes that investors are concerned about at the moment, inflation and etc. And those long income stories and healthcare stories are just seen as more robust against some of the troubles that we've got in the equity markets at the moment. I think just probably turning over the slide. In terms of the sort of listed REIT market, as Richard mentioned, we've seen a phenomenal expansion over the last 10 years. And that's been led by the IPO market. There has been over 40 IPOs over the last 10 years, i.e. 40 new property companies coming to the market. The majority of that happened in 2013 to 2017. And a couple of kind of key trends that we observe when we look at this IPO market. The majority of these have been externally managed companies. That might perhaps be a bit of a surprise. Investors tend to have a preference for internally managed companies, which they believe have more alignment between the manager and the shareholder. But the external management allows an incentivization for people to list vehicles, and that's one of the things we've seen here, and it's one of the reasons why the listed markets have been very on their front foot with the alternative sector, and that's why there is a good sort of wide, diverse collection of REITs in alternative property spaces. So lots of externally managed companies. I think I'd also make the point that whilst we sort of saw the main sort of IPO activity in 2013 to 2017, the last 4 years have been quieter, but things have got done. And I would flag actually a company that Jefferies worked on, Life Science REIT, that was the first life science company real estate company to come to market last year, and raised 350 million. But we've also seen others such as Home REIT, and Tritax Eurobox back in 2018. So more difficult IPO markets, I think I'd be fair to say, but things do get done if they're a little bit different and they hit the themes that investors are concentrating I think just turning I suppose I should mention just on the IPO markets, we've also seen lots of companies try and fail. It is never easy to IPO a company. And I think I'd especially concentrate on the residential sector. It seems to be just more difficult to get residential REITs onto the market than the more commercial REITs. And there are some structural reasons for that, including the fact that several or an important constituent of IPO activity has been people like wealth managers, and those wealth managers tend to be a bit more nervous about residential because their underlying clients already have large residential exposure. Sorry, just turning on to the next slide, we're on to ECM activity. Sorry, Laura. I think the reality here, I just want to make a couple of points. Whilst the IPO market has been certainly more difficult over the last couple of years, we have seen the existing REITs being able to raise capital very successfully. And huge amounts of capital have been raised over the last 5 years for existing REITs. Again, reflecting what we were talking about in terms of premiums and discounts, it is certain subsectors which have really been able to issue new stock. And the ones I would highlight here, the long income subsectors, such as companies such as LXI REIT, and also the industrial and logistics subsector. And again, Tritax Eurobox, Tritax Big Box, and Warehouse REIT, good examples of companies that have been able to issue stock from that subsector. Again, in the alternatives, we've also seen people such as the self-storage companies and the healthcare companies, again, being very popular with investors and being able to issue new stock. We will touch on this in a minute, but one of the kind of themes that we've noticed is the investment propositions of companies issuing new stock are certainly becoming more complex, with many more companies now focusing on doing more developments. And essentially that's really to try and hit their total return thresholds. As we've seen cap rates come down over the last 10 years, REITs are still sort of scratching their head in terms of how they're going to get that 8 to 10% return threshold that they promised investors. I think another theme, and just turning on to the next slide, is M&A. And for the last, well, since the great financial crash up to about 2020, the M&A markets were really pretty quiet. There was not a lot happening in the public space. The odd takeover, but not a lot. With the COVID pandemic, we started to see the sort of the green shoots of activity, and that really demonstrated itself by stake building. Lots of private equity companies mainly starting to take decent sized stakes in listed vehicles. Once confidence then improved a little bit, we started to see that stake building turn into actual takeover activity. And there's been 8 recent UK public to private transactions, or public to public transactions. And there's really 2 themes kind of in those 8. We've listed 7 here, and the one we haven't listed is a very small one, custodian REIT and Drum, which was happened last year. The 2 key themes that we observe on the M&A side is one, private equity take privates, and what's happening there is PE houses who can often use far more leverage than really is available in the listed markets, can use that leverage to pick up often misunderstood or poorly rated for sort of lots of different reasons stocks and get themselves a bit of a bargain. And one example, I guess, of that is GCP Student. It's a student accommodation company, slightly under a cloud over COVID because of the effect on occupancy with international students not being able to travel, and that got taken private by Blackstone last year. The other theme that we're seeing in M&A is just a general consolidation theme. The listed markets constantly want their REITs to be bigger, and that is linked to liquidity and trading liquidity and being able to get in and out of the stock, etc. And therefore, what we're seeing is some of these smaller stocks with very little liquidity have really suffered over the last few years and struggled to attract new investors to the register. And therefore, the consolidation theme, where they then team up with a bigger player, it makes perfect sense to them. And a good example was one we saw earlier this month with Workspace and Mackay Securities. I think just going on to the next slide, and I'm conscious we're rattling through this at some pace, but we can always pick up with Q&A if you've got any questions on it. I just wanted to put out a few observations that we might have touched on, but go into a little bit more detail on. First one is what I called an increasing focus on total return. And the point here is, whilst income is always going to be a key component for REITs investment returns, as cap rates have come in, REITs have started to adapt a little bit more and have more value add strategies. And that's being reflected in terms of just essentially a little bit more development. The amount of development risk really varies, and you have companies such as LXI REIT who do lots of forward fundings, to companies such as Tritax Big Box with their DB Symmetry deal, which added a huge land bank to their portfolio. But we're definitely seeing people take a little bit more risk to hit those returns. In terms of debt levels, again, I mentioned that how important those debt levels are from an M&A perspective, and I think it's just worth mentioning here, the typical leverage for a UK listed REIT is somewhere between 25 and 40%. Investors do have since 2009, investors have typically wanted leverage to be low. They will take a view on a subsector, and if you've got long income supermarkets with cracking covenants, then obviously you can have a little bit more leverage than shorter leases with non-cracking covenants. However, that LTV is lower than what we would see in the private space, and that does have various effects, especially in a more active M&A market. No real surprise on my next point, just around inflation. This is something that the wider equity markets are very focused on at the moment. And in times of inflation, there is always a little bit of head scratching about how perfect the REIT hedge is to inflation. I.e., is a REIT actually essentially a bond proxy, or is it really linked to GDP? Is it more sort of linked to the general economy? And we see that sort of debate happening at the moment in the REIT market, and different subsectors arrive at different answers. So one of the sort of safe harbors in an inflationary storm is certainly seen as the long income stocks with their inflation linked increases in their leases. Whereas we get a bit more worried about some of certainly the retail stocks with shorter WALTs and a sort of lack of ability to perhaps increase their rents over the next few years, which will have a big effect. Again, the REIT's ability to pass their inflation through to their tenants is going to be key here. I think I'll just finish on ESG before handing over to Matt. I guess ESG is a really tricky subject for REITs at the moment, and management teams are spending a huge amount of time on it. And one of the things that I would observe on an ESG perspective is ESG means something slightly different to everybody, and that's one of the reasons why REITs are really struggling with it. And breaking it down into individual components, whilst everybody accepts the G, governance, good governance equals better performance, I think that is accepted. I think it's the E and the S that cause a lot more head scratching. Now, there is a sort of slow realization that especially with sort of government regulation around EPC ratings, that if you have older property, if you have property that's potentially going to be obsolete, then that's going to create much higher capex requirements, and therefore there is going to be a profit margin here. There is the better properties you have, you'll have to spend less capex on, and therefore that will feed through to the bottom line. So there is a sort of realization or a sort of financial effect coming through, which I think is important because that kind of makes it easier for people to grasp what they need to do from an ESG perspective. Equally, I think rating agencies are still kind of in their infancy, and we're starting to see people like GRESB really growing in importance. And I think that will help REITs to understand what investors want to see from an ESG perspective. Probably on that, I'll pause and hand over to Matt.
Morning. Thanks very much, Tom. I think Tom's gone into a little bit of detail there on the ESG agenda and potentially stolen some of my thunder for this presentation. Just by way of background, I'm a manager in our digital risk advisory team and currently wearing two hats. So that's both a service delivery from an ESG perspective, so across the advisory and assurance space. So that's GHG emissions assurance in line with the streamlined energy carbon reporting. And advisory pieces around sort of internal audit and baseline reviews. The second hat is also leading on the development of our net zero roadmap internally, so working with a number of key stakeholders across the business to design and ensure that we can meet the targets and what have you that we've set from that perspective. Laura, if you could just move on to the next slide. So as Tom said, that the ESG agenda is incredibly broad. This is taken from the MSCI landscape. So really the main question is, given its breadth, and it's split into three separate pillars, with governance kind of providing that oversight to the two distinct areas from an environmental and a social perspective. The key question is really, what do each of these areas mean for an organization? And it's really around taking some time and resource and what have you to work out exactly what these individual areas do mean to each organization, because each organization is different. And what we don't want to see is that the organizations are doing the same thing to align with certain frameworks and what have you, whereas actually the work needs to be done internally to determine exactly what this means to each individual organization. Laura, if we could just move to the next slide. So I guess, as we know, there's been a huge amount of change in this area, and ESG, sustainability, CSR, and what have you have really taken some precedence in terms of discussions and what have you. And certainly some of the work that we've done across the risk landscape, the ESG has really found its way onto the board agenda. And this has kind of evolved really from the kind of a corporate social volunteering, grassroots, employee-led area. And we're now seeing a kind of amalgamation or a meeting in the middle, really, where this is on the board agenda, and at directors there's a number of discussions going on, but there's also that sort of grassroots environmental champion kind of initiatives that are going on and still trying to drive this internally, in part as organizations are trying to work out exactly what this does mean for them. We can see that there's a number of drivers for change. So this has come in part due to changing government regulation, which is constantly evolving, as we'll come on to in a minute. There's also risk and opportunities that have been reviewed and looked at internally to the business. These are again specific to sector and organizations as well. But there's also an element from customers and employees that they want to be associated with purchasing goods and services from organizations that are doing good in this area, and really feel that the ESG, sustainability, is a key part of their business makeup. And the same with employees. They want to work for an organization that cares about certainly the social agenda, but also the impact that they have on the environment, and that they have considered their impact, and they are looking to reduce the likes of footprints and things like that. And the last real driver there is around the shareholders and investors, and the need and the kind of reputational risk of being associated with an organization that hasn't looked at this internally and considered really where they're going to go. I suppose, given this has changed from a kind of a nice to have, there are a number of benefits for looking at the ESG agenda and sort of pushing it forward and ensuring that I guess the most effective ways of moving that forward is from a holistic view. And that all of the key stakeholders within the business, their views and what have you, have been considered, and that they are driving that change, but also making sure that the structures are in place within an organization to capture data and ensure that that can be reported effectively, certainly as the kind of the reporting and regulation landscape is kind of being driven forward. Just on that note, Laura, if you could just move forward. So just on that kind of evolving regulatory landscape, a lot of sort of standards bodies and what have you were set up kind of 15 to 20 years ago, and they've been slowly evolving. There's been a huge amount of change since the 2015 Paris meeting, with the 17 Sustainable Development Goals were developed by the UN. So there's really been work over the past 7 years to incorporate standards into a lot of what we do, but also have oversight bodies and what have you. That's really changed kind of dramatically over the past couple of years, with the introduction of TCFD and the way that that's going to be effectively, well, requiring a number of companies dependent on size to report sort of towards 2025. As we can see from this, that a lot of that work has happened over the past 7 years as things have evolved, but also there's a lot being done to amalgamate standards boards and trying to make reporting and alignment to framework standards and what have you as easy as possible. It's certainly been noted as one of the real issues has been the breadth of standard boards and the breadth of frameworks and what have you that the organizations can align to, and that is across sectors as well. So it's taken a lot of research and resource for organizations to try and find the right framework. And have had to do a lot of work before government and what have you have put in place a number of these regulations to enable mandatory reporting and trying to align organisations in a certain way. If we can just move one slide there, Laura. So I guess I suppose the key question, or the most important question, is we understand where this has gone, that it's evolved from a nice to have. There's been a number of drivers for change. Organizations really want to become as sustainable as possible. Obviously, there is a look at profit and how that impacts the operational running of the business. It's obviously going to take a reasonable amount of resource for organisations to complete the likes of materiality assessments and drive strategy and embed that within a business, considering the evolving nature of the sort of the regulation landscape or what have you. So the key question really is, well, where is that going? I mean, I think as I've sort of alluded to, that there has been a lot of change over the past year or so with the amalgamation of standards boards. So we've got the IFRS Foundation has started to amalgamate standard boards to create the ISSB, the International Sustainability Standards Board, and this will feature kind of across other standard related bodies as well, that will then enable a slightly more standardized version of reporting for organizations to hopefully align to and make things slightly easier. As I've already said, there's also work on the TCFD and organizations having to understand where they are across those 4 metrics to then report accordingly and build that into the business. There's also a lot of work being done around science-based targets and understanding net zero targets, aligning to kind of collaboration groups, GFANs, as an example from the financial sector, where net zero targets and reducing scope 3 emissions across the entire supply chain is something that needs to be looked at and embedded across the business. There are a number of other areas specific to real estate with regards to GRESB and EPRA, with regards to ratings agencies, as Tom mentioned, and those are going to become of more importance, and they are still growing. I suppose, you know, there is the likes of the EU taxonomy, UK taxonomy, and kind of an evolving agenda, but I suppose that's the kind of the key part really to this, that it is consistently evolving and continuing to evolve. But given the time frame, certainly for hitting kind of net zero targets and reducing certainly the environmental impact, we've really got until 2030 to embed a lot of that in sort of day-to-day operations. That there will be a number of changes over the next couple of years, but we're starting to see those kind of mature now with regards to TCFD and getting things in line. So there's no kind of easy answer as to this is exactly how it's going to look over the next couple of years, but we can really see the foundations for that in the amalgamation of standards boards and the government really issuing regulation and what have you to help businesses report accordingly and in line with their sector and their organisation. That the key part really is for the organisations themselves to look internally and make sure that they understand what ESG means, and then make sure that capturing of data and what have you is built in. Capturing data certainly in the real estate sector is incredibly difficult given the infrastructure of older buildings and occupancy of those. So that's something that needs to be looked at, but by getting those structures in place is a really important first step really, and will help drive future reporting requirements as they come in. If you could just move to the next slide, Lara, just to finish up before passing on to Vincent. So there's just a couple of key considerations really as to, well, has ESG been considered, and is there clarity across what this means for the organisation? Have the risk and opportunity and development of strategy taken place? Has the likes of a net zero target been set? Has the work internally been done to capture the relevant data, and also making sure that aligning to frameworks has been done across the E and the S, as well as the oversight of the G? And then also, you know, is this considered at the board level, and is this something that is kind of being embedded within the organisation to really drive change throughout that organisation as this agenda is kind of continually evolving? And on that point, I'll just pass quickly on to Vincent to continue with the presentation.
Thanks, Matt. So, morning, everybody. Today I'm going to cover some tax issues relating to REITs. I'm going to start with some brief comments on the wider funds review currently being undertaken by the government, then some specific changes to the REIT rules that will take effect from April. Next, some potential changes that are under consideration, and finally some thoughts on so-called private REITs. So the wider funds review, it was 2020 when the government first announced a review of what is currently a very diverse and complex funds landscape. The stated aim of this work is to enhance the UK's attractiveness as a location both for fund vehicles themselves and also the associated asset management activities. So what's been achieved so far? Various initiatives are in progress, but arguably the most significant is a brand new type of fund vehicle called the Qualifying Asset Holding Company, which has been dubbed a QAC, which becomes available for the very first time this April. The government hopes that this new tax-friendly regime will persuade asset managers to locate both themselves and their asset holding structures in the UK rather than, say, Luxembourg. We don't have time to cover this in detail, but it's worth noting that QACs will only offer potential tax exemptions for structures holding non-UK property. By contrast, REITs, of course, only offer tax exemptions for UK property. So just to say, both regimes allow holdings of both UK and non-UK property, but the exemptions are restricted to the ring-fence part. So where do UK REITs fit into the ongoing funds review? And will this lead to benefits for investors in UK real estate via a REIT structure? Despite previous relaxations, the good news is that a central theme of the funds review is still a perception that there are unnecessary barriers and complexity within the existing REIT rules. Positive changes have begun to filter through, and we'll look at these on the next slide. So these are already enacted. Finance Act 22 received royal assent on 24th of Feb. The most eye-catching is the first listed here, the removal of the need for REIT shares to be admitted to trading on a recognised stock exchange, provided institutional investors hold at least 70% of the ordinary share capital in the REIT. We'll discuss the implications of this in a bit more detail in a minute. Speaking of institutional investors, however, they now benefit from two key relaxations to the REIT rules. The first is the admitted to trading condition mentioned above. The second is that a REIT cannot be a closed company unless that is only because it has a participator, broadly an investor, that is a qualifying institutional investor. The qualifying institutional investors, all the usual suspects, pension funds, charities, sovereign wealth funds, insurance companies, authorised units, trusts, etc. But it does also include overseas REITs. And the change here is that going forward, an overseas REIT will be defined by broad characteristics such as how widely it is held, what it invests in, how it is taxed, and whether or not it distributes its income, rather than a line-by-line comparison of the relevant overseas REIT regime to the UK REIT regime. Where a REIT pays a PID to certain corporate shareholders that have a 10% or more stake, the REIT may become liable to a penalty tax charge. This is to compensate the UK Exchequer for the fact that if a shareholder is resident in a country with a double tax treaty with the UK, it may be able to reclaim some or all of the 20% tax withheld on the dividend payment. The new measure changes the rule so that the penalty can only apply to shareholders where there can be no loss of tax because the shareholder was entitled to gross payment in the first place. So that's a bit of a no-brainer, you would think. Up to now, to check if a group has passed the balance of business test, broadly whether the rental business is at least 75% of the total, the group is essentially required to complete the HMRC's financial statements tool, which is essentially a potentially massive spreadsheet, with each company having its own column, which then has to be populated with some very specific figures taken from the individual accounts, but with some equally specific exemptions, mainly intragroup items and valuation movements. And this has to be done for both the exempt property rental business and the taxable residual business. So two big spreadsheets. The relaxation. Well, going forward, instead of having to analyse each company's accounts in the group, the starting point is the consolidated accounts, from which the REIT can prepare a single statement for the total property rental business and another for the residual business. If these just two statements show that the property business is more than 80% of both profits and assets, the pain stops there. If it doesn't, then it's broadly as before, preparing numerous financial individual statements to show whether or not the 75% tests are passed. Similarly helpful is the fact that going forward, any profits made from complying with planning obligations are not counted as profits when performing the balance of business calculations. This is helpful because it serves to increase the percentage attributable to the property rental business. So moving on to potential future changes. 2022 has already seen the publication of the latest instalment of the funds review process. And encouragingly, a number of the potential changes that were put forward by respondents to the consultation are under consideration, including removing the requirement for REITs to be subject to both the corporate interest restriction and the interest cover test. These measures have different aims, with CIR designed to protect the UK tax base from debt push-down strategies in overseas groups, and the interest cover test aimed at discouraging overgearing. But it does not seem unreasonable to ask the government to choose between them, particularly given the tax-exempt environment in which REITs operate. Making the 3-year development rule more in tune with commercial reality, for instance, by allowing any charge to be calculated by reference to the fair value just prior to the development, rather than going right back to original cost. Removing the requirement for a company to hold at least 3 properties. This would allow REITs to qualify even if they hold a single property, such as a large warehouse. Amending the rules so where a REIT holds overseas property in the UK company and suffers overseas tax, withholding tax should not be applied as a second layer of tax when distributing that income to investors. Removal of the holder of excessive rights charge on PIDs to 10% plus shareholders to cover certain qualifying exempt entities. Again, something that can be done without risk of loss to the Exchequer. Further potential changes, broadening the definition of assets qualifying for the REIT regime, such as property-backed debt or even infrastructure or renewable energy assets. A seeding relief, the stamp duty land tax for REITs to ease the transition into the REIT regime. Now this would be a big step, but it would certainly act as an incentive. Making the requirement to calculate capital allowances optional. Given the main impact of claims appears to be a reduction of PID, and some REITs may not be worried about the size of the PID against other dividends. amending the proportional basis on which the capital gains tax exemption applied to the disposal of rights in UK property-rich assets. So finally, the government's responses paper mentions two other possible changes being considered for quacks and which will also impact REITs. These are one, a review of the definition of institutional investors, and two, a more general review of the non-closed company condition, although both these are being considered over a longer timetable. The last slide is rise of the private REIT. The backdrop here is the previous relaxation in 2012, which allowed an exemption from the closed company requirements for REITs owned by one or more institutional investors, such as pension funds or collective investment schemes operated as limited partnerships. The stated aim of that relaxation was to attract institutional capital into the UK built environment, and it worked, with around 1/3 of REITs now being owned by institutional investors. These are often referred to as private REITs, where the key characteristic is a REIT whose shares are not widely held or marketed, albeit the ultimate ownership will be widely held. So up to now, investors who don't require liquidity in their shares have nevertheless incurred significant costs with little benefit from their shares being listed. Hence why most of them list on the International Stock Exchange in Guernsey, with lower costs and lighter regulation, including no requirement for a free float. The key question is whether the removal of the listing requirement, where institutional investors hold at least 70% of the ordinary share capital, will encourage more institutional money into the UK property market. The early signs are that some businesses who are putting off becoming REITs by the listing costs are now considering entering the regime. Equally, it will be no surprise if a few of the private REITs listed on TISI now consider delisting to save costs. The fight for institutional capital has resulted in those institutions being offered an increasing array of options for the tax-efficient structuring of their investments. But the use of a REIT presents some distinct tax advantages, which, together with further simplification measures in prospect, will fuel expectations that increasing numbers will choose REITs. The new landscape will present some interesting opportunities for the up to 30% of investors in private REITs who are not institutions to benefit from the cost savings of not having to list. It remains to be seen how asset managers and investors will respond to this change, although HMRC are likely to be alert to ensure against any perceived abuse. For non-private REITs, benefits remain strong, as Tom was saying, particularly those targeting rapid growth by raising funds from new investors for deployment in investment pipeline. And as mentioned by Richard earlier, over 3.5 billion was raised by REITs on the main market last year. Whether for funding or an exit, a good track record on the LSE will serve to increase marketability by creating confidence for stakeholders and investors. So that's me. So now I will hand over to our chairman.
Thanks, Richard. And thanks to all our speakers so far. Good morning, everyone. So for those who don't know me, I'm Simon Hall, and I'm a director in the corporate finance team here at BDO, and I specialise in real estate and capital markets transactions. I'm going to give everyone a couple of minutes to come off mute as they've all joined me on the screen for the Q&A. Thanks to those who've submitted questions so far. We have a number to go through. If you have any burning questions, do use that Q&A at the bottom of the screen, and we'll try and pick up as many as we can in the next 10 minutes or so. The first question come through about a request for the presentation afterwards. The answer is yes. So we will share this presentation, follow-up materials, and our details if you have any other questions that we don't get through in the next 10 minutes or so. So to start off, I think I'm going to go to Tom. Obviously, the introduction of unlisted REITs is a big change. What do you feel the impact might be on the UK listed space? I know Vince touched upon it.
Yeah, it's a good question, but I think as Vince made the point, private REITs or quasi-private REITs are not particularly new. There have been private REITs on the Channel Islands Stock Exchange for a while, and whilst the listed REITs and the private REITs are obviously both taking advantage of the tax wrapper and to a certain extent the branding of being a REIT, I think the reality is that the REITs that go for the listed markets are also looking to get into the capital markets. They want to raise equity. They want the oxygen of public market sort of reputation, etc. And they want to offer their shareholders ongoing liquidity via the ongoing sort of trading on the stock exchange. So I think both of the private REITs and the public REITs have slightly different aims and ambitions, and therefore I don't see that one is going to cannibalize the other in that way. I think both can coexist very happily.
Yeah, I think that's what we're seeing so far in our discussions with clients too. And sort of forwarding that on to Vince, are you seeing a lot of clients actually thinking of onshoring, and institutions in particular, looking at the unlisted REIT sort of process as opposed to maybe looking at TICE?
Yeah, I mean, I think, as I said, part of this wider funds review is the introduction of these new entities such as these quacks, which, if taken alongside a REIT, seem to complete the set of kind of entities the revenue have set up very deliberately to stop any tax drag, and ensuring that profits are going straight through the UK and out to particularly exempt shareholders. So yeah, I mean, funds are sort of interesting to see what they will do. I mean, REITs do, they have as I said, an increasing array of sort of structural aspects that they can consider now. You can often achieve something similar with partnerships, for instance, or unit trusts, but REITs do offer these key advantages in, for instance, the capital gains tax position has changed a lot. So you've got overseas investors having capital gains tax issues for the first time. You've got an increase in corporate rates, 25%. So that the REIT, which offers a tax-free environment, and very particularly actually the step up in base cost with where properties coming into the REIT, and a step up in base cost when properties exit the REIT. I mean, that's something that you won't find in many of the other structures. Also, a lot of property changes hands in a corporate wrapper. Again, something that some of the other sort of structural options will struggle with, but something coming into a REIT, immediate step up straight into the REIT regime, and that's what it's designed to do. So yeah, I think it's all very, very, very positive, and we should now start to see the fruits of that over the coming years.
Yeah, thanks, Vince. And so Tom, jumping back to you, we've got quite a specific question around risk. I think it's more geared towards liquidity. What do you see as the main risk to those sort of lower traded stocks in the REIT space, particularly around liquidity for the listed ones?
So this is sort of stocks, I'm presuming, that they're trading at big discounts. There's two ways you can sort of look at this. There's the risk of on the property side, but actually I'm assuming that whilst they are smaller, let's just assume that they have good direct property, and that is all sort of that's all working, and therefore this really comes down to a size question. And look, if you are illiquid and you're listed on the stock markets, you do struggle to attract the sort of larger institutional investors, and the simple reason for that is, people list on the stock market to have the liquidity, and if you're putting £20 million tickets into £50 million REITs, then you're not going to be able to trade out of that in a hurry. That's a sort of inefficiency, if you like, of the capital markets. How does it correct? Well, the capital markets are very good at cleaning themselves up, and therefore, if something is trading at a discount then maybe we'll see M&A activity to correct that valuation discrepancy. Equally, over time, we see that there is horses for courses here, and smaller REITs may focus their attentions more on a retail investor base, who obviously are less sensitive about being able to trade big numbers in and out on a daily basis. And they may focus more on wealth managers, who are, again, for similar reasons, because of their underlying beneficial holders being relatively small, again, are less worried about liquidity. Probably that answers the question a bit, Simon.
Yeah, I think so. We've had one just in that's on a similar sort of theme. You mentioned these sort of overweight resi stocks. Do you think that's the only thing holding back the alternatives premiums to NAV in the market?
So look, my point on resi is it is a vast portion of the direct property market out there, and yet it is a relatively small proportion of the listed UK REIT audience. And the question is, why is that? And partly it's to do with some technical factors, the FRI leases that exist in commercial property versus the sort of gross to net leakage that we see in residential. It's a more complex asset class, and therefore with that gross to net leakage, which is created because of the obligations to keep the buildings up, generally sitting with the sort of residential REITs rather than being passed on to the tenants, as we see with the commercial REITs. That creates less income to distribute, and therefore they can't have as a higher dividend yield. But I think there is also this point that a lot of the investor universe, and if you see a sort of typical IPO, 200 million, let's say 250 million IPO, a typical IPO would have a third of that from wealth managers and retail investors, and they are not investing in the listed markets to sort of, they already have their house, and therefore they're investing in the listed markets to diversify their asset pool, and therefore it isn't something that they're naturally drawn to, putting more money into residential properties. So a few sort of technical reasons, a few sort of common sense reasons why I think residential has struggled to get off the ground. But we do see some very successful companies out there, and Granger, Home REIT. There's some really good residential REITs. It's just there's not enough of them.
Yeah, thank you. And apologies, you're quite popular this morning, Tom. Obviously, there's a lot going on in the markets at the moment, but I think what we'd seen is a lot of companies queuing up to IPO towards the back end of last year and the start of this year. And obviously, there's been a bit of turbulence in the markets. Do you think it'll come back? And do you think the rest of 2022 is going to build up in terms of the IPO landscape?
I think it will. I think definitely on the secondary side, i.e. existing REITs will still be able to raise money. The IPO market has been trickier for a while, and one of the reasons behind that is that actually, if there is a company that already exists in the listed markets, and let's just say that company is trading at a discount, then it is very difficult to IPO something doing the same. Why would an investor logically buy something at par when they can get the same asset exposure at a discount from something that's already listed and potentially has kind of passed through the IPO execution risk phase? That said, the listed markets love more than anything something that they can't already get their hands on. And therefore, if we look at what's IPO'd over the last few years, and Life Science REIT is a great example, it is something that there wasn't there beforehand. That you couldn't get pure play exposure to life sciences real estate in the listed markets before November last year. And therefore, we will continue to see that theme, that there will be new subsectors of real estate that come through. And I think that's going to be exciting. And I think we're going to see plenty of IPOs in that space over the next few years.
Good news, certainly for us in corporate finance. I'm going to pivot over to ESG and probably bring Richard and Matt into the conversation. Richard, are you seeing a lot of the real estate space really focusing on ESG? I know when we're looking at IPOs, there's an ESG committee on most boards at the moment, but are your clients really focusing on it now? You're on mute.
Thanks, Simon. Yeah, I think it's been a real trend over the last few years. As Tom referenced earlier, ESG means different things to different groups, but if we assume that most of the listed groups had pretty good governance to start with. If you then focus on the environmental side, most of the groups really are on a journey over the last few years. Started a few years ago where many of the landlords said, well, the environmental aspects don't really impact us. The environmental aspects are really down to our tenants. But there's been a real shift over the last few years, and especially over the last 18, 24 months, with landlords really embracing what the E and the ESG means, and really understanding that investors want to see a lot more information about how they are tackling that. And that also goes with the S and the G of ESG. So it's a trend, it's a continuing trend, and I expect that investors will really start to differentiate those companies that distinguish themselves in that area.
Yeah, thank you. And Matt, within a real estate or even broader, do you see any businesses that are really sort of at the vanguard of ESG and benefiting from it with their stock prices?
Well, so I think we're seeing a number of organisations that are embedding this well into the business, and that is obviously having a positive effect from a financial perspective. I guess from a REIT perspective, I think the organisations that are kind of having the sort of the E or the S as a key focus of their business is something that is then increasing either the profit, but it's certainly increasing that relationship that they have in the industry. So I think Home REIT and what have you, that what they're doing, it's incorporating or more the S in this instance into their business model, which is then kind of having that positive relationship. I think across other sectors, really what we've seen is that the organisations are now working on what they had within the business already. There was a lot of good elements of data capture and what have you within the business, and now they're really building on that to kind of either drive profit, but also I guess the kind of the reputational side of things within that organisation and the external facing sides of that.
Brilliant, thanks, Matt. And Vince, we've got a couple of questions on sort of developments and impacts for REITs. Really briefly, it's quite a technical point. What are the rules around how much development REITs can undertake as a portion of their total portfolio? And then sort of following on from that, Tom, do you see that is a sort of conflict with the types of IRRs that these REITs are trying to achieve?
Well, the development as such is fine, because development to hold is absolutely fine. I think the rule that I was referring to in terms of it needing updating, for instance, is the rule that says if you take one of your properties and then you develop it and add a 30% sort of cost to that 30% of the cost and development costs, and you sell within 3 years, then that will be sort of taken out of the regime and not taxed in an exempt way. So I think so if you're developing to sell, then that's not going to work for a REIT. For developing to hold, that's fine. But then there's the margins, the kind of opportunistic developments where you just need to be careful and take a view.
And look, from a conflict side, no, I don't think it's a conflict. As Vince has explained, you can develop to hold, and I think the real sort of crux of this question is around, as REITs do more development, they need to be careful and manage that development risk. But it is still a relatively small part of the average REIT's portfolio. What we're really just getting is slightly more well-balanced companies who are doing a little bit of development alongside their existing properties, and by doing that, managing to create a little bit more shareholder return from that.
Thanks. And conscious of everyone's time this morning, I think we're going to leave it there. Apologies if we didn't get around to your question. We will be sharing the materials after this, along with our details in case you want to ask us questions directly. But with that, I'm going to hand back over to Richard to close.
Thanks, Simon. I just want to say thank you to all our presenters, to Tom, to Vince, Matt, for all your insightful presentations, and to Simon for leading the discussions. Simon said the copy of the slides and the recording of this morning's presentation will be sent to you later, together with the recently updated BDO REIT guide. Thank you to everybody who attended this morning, and wishing everyone a very good day. Thank you.